Stocks were kind of in a really kind of holding pattern after a really good week last week. Kind of holding a lot of those gains, not losing any of them, a little bit of up and down, and then boom, at the end of the day, closing at the highs of the day with a really strong move to finish. How bullish was that move in terms of our intermediate expectations? Are we starting a new intermediate run across all these different indexes? Can we expect multiple months again now of good bullish moves after a little bit of volatility that we've had? So I'm going to break that down and see what these different charts and what the technicals look like and what to expect. Some, what if we are strongly bullish as we are in a long-term basis? What does that mean in terms of our potential for how much longer we can be bullish and how much of a move we'll get to the upside, considering the strength of the long-term bullish moves that we're seeing, not just in stocks, but across other different asset classes in this risk appetite category. So we're going to break that down. We're going to take a look at a stock that's been as sideways as it can be for the last so many months, having its own breakout. Kind of indicative of a lot of other stocks that we've been trading in our classes, in our trading rooms. So I'm going to use that as an example for our trade idea today. So let's go ahead and get started. Today is Monday, March the 15th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator like we always do. And you can see today's rally closing right at the high of the day here. Well, 2 points off, 1 point off really, but still pretty much right at the high of the day, closing above all these highs. The intermediate line has gone back into the reversal zone, so strong bullish posture. Again, the continuation, this was not a pullback, so this is continuation of the current bullish trend that we've been on now. Now we're going to March 15th, so we are over 4 months. We started this November the 5th. So we're going into March 15th, so over 4 months of this intermediate posture. You notice the near-term line, though, is still not able to really get in that reversal zone itself. It's actually still falling, or it rose up a little bit there. Actually, you know what? Let's see. It did pop up with the blue. You can't see it there on the green line. It did pop up to 87. The momentum line popped back up, though not to high levels, so we didn't get the cluster. The market sentiment line looks like it's starting to slowly turn. Like it hasn't turned up yet, but you can see how it looks like it's about to turn back up there. The Dow Jones Industrial Average, of course, that's been the most bullish one. It's got the near-term line well in the reversal zone. Same thing with the Russell 2000, well in the reversal zone, all the way up into the 90th percentile or the 99th percentile there. The intermediate lines in the 90th percentile, very, very strong moves. You can see the ranges are getting smaller, not surprising, as we talked about before. The ranges are smaller when you're above the 30-day moving average than it is when you're below the 30-day moving average. They tend to be much bigger. We are actually still below the 30-day moving average on the NASDAQ. It's light green shading. The intermediate line's bullish. It's not above 50 yet. And we still have a yellow line. The intermediate line, the moving average is turning up slightly enough to turn yellow, but we're still below it. So again, we have to kind of get above that for this trend to change. For the NASDAQ to show the same thing that we're seeing on everything else. See, all these other indexes are well above their 30-day moving averages and well off of, pushing up to new highs, well off to 23% retracement levels, all of them, right? The Russell, the NASDAQ, the Dow, but not the NASDAQ, or not the NASDAQ. The NASDAQ had not only broken the 23%, unlike the other three, but it also broke the 30 and 50% levels before bouncing back up here and still unable to get above the 23 levels. So we're still not quite back above. The intermediate lines below the market sentiment. That's not the case for any of the others. We're back above it on the Russell. We're back above it on the Dow Jones, and we're back above it on the S&P 500. So all those intermediate lines are back into the reversal zones, back above the market sentiment lines. The moving averages, we have dark green shading and green line on all of these. The only one that's different continues to be the NASDAQ. Remember, the NASDAQ was a much stronger outperformer for so long. And then once we had this intermediate pullback, it struggled to get going, and the Russell took off like a rocket. So from a relative strength standpoint, we still see that weakness showing up here. We're up a little bit today, popping up to the 1.36 level, but you still see we're well below the 8-day moving average of the relative strength line. We're still easily below 40 on the RSI. The CCI is still easily below negative 100, and the MACD is about as low as it can be. And PPO pretty darn low too when you look at it, especially on a 50-day basis. When you look at the long-term PPO for the, give it a second to load itself up, but that long-term 50 and 200-day moving averages, see how low that's continuing to get, 7% below the 50 days, below the 200 days. So pretty significant bearishness on the relative strength. So that hasn't continued yet. Remember, for this pullback to occur, more than likely, as we saw in June, when we had the weakness here on the broader market, that wasn't quite a pullback, but it was about as close to one as you could get, similar to what we saw now, right? Again, it's very similar, right? Back in June, this pullback here was very similar to this one that we've had. Almost about as close to a pullback as you can get without actually being one, versus this one, which was, right? So you see the big difference up here and then over here compared to what we saw in September and October. And that was barely an intermediate pullback. That was about as little as one as you could possibly have and still be qualified as a pullback, versus these others were about as deep of a noisy period as you can get without qualifying as an intermediate pullback. And so we're back on it, and we're back again. Very long intermediate run, very long intermediate run, very shallow exhale in between. And you can see where the Fibonacci lines are for this longer term move, and ultimately where any exhale could get to on those orange lines. But first, the black lines are what matter, because you have this current intermediate run that they are measuring a potential retracement for. And a retracement doesn't start until you enter the retracement zone, which is the 23 to 78% level. The retracement doesn't start until there, and it actually ends. Now it's more than a retracement. It's actually a trend change when you break the 78%. When you bounce down, so on the NASDAQ, when you bounce down below it, so its retracement did start here. When you bounce down below it, it doesn't end until you get back up above it, right? Back above the 23%. And that's why we're kind of watching that level to see if the NASDAQ shows a similar pattern that we're seeing on the other indexes. Whereas they did not have a pullback, this one would be the beginning of a new run. Probably wouldn't last very long, considering that none of the other indexes have even started, have ended their previous run like the NASDAQ did here. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That lets us know that you liked our video today and that you want us to do another video again tomorrow. Of course, if you don't like our videos, you don't have to click on anything. You don't even have to watch. But if you do like our videos and you want to let us know, you can do it with one click down there. That helps us out quite a bit, actually, when you do that. So we appreciate that for those who do. Also, while you're down there, comment. What did you get out of the video today? What stood out to you? What questions or comments do you have on anything I covered in the video today? Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. You get access to our Market Outlook forum, our message board on our site, so you can be able to interact with other viewers of the video, other members of our Market Scholars community. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there at DavidSettle42, so you can find me there on Twitter. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on YouTube or on our website, I invite you to check out these things over here on the right, our trading rooms, our classes over here under upcoming events, as well as our Market Outlook Live. This is where I review all the trade ideas I've talked about in my previous Market Outlooks. I continue to review them until we close them. So I post that in this live video. Every day I do the Market Outlook, I do a live video at 3:30 Eastern time. All of our subscribers get access to that, our premium as well as our monthly subscribers. All of our paid subscribers also get access to all of our trading rooms. Our premium subscribers get access to all of that too, of course, as well as our class forums and other premium tools. You can see, if you click on pricing, you can see what the different levels get, what our monthly subscribers get access to, as well as our premium subscribers. You can see it's a lot more for, on average, a lot less money per month. That's why most of our subscribers end up being our premium subscribers. Also, while you're on this page, come down here to the bottom and click on this heart. It opens up a new tab. You can hit this like button right there, and come down here to the bottom as well. Click the thumbs up icon, opens up another new tab. You can come down here and hit this like button right there. Again, the more you do that, the more, it's actually right here. And the more you do that, the more people will see our content. It will reach more of our followers. That's how these algorithms work. The more engagements, the more comments they have, the more it's shared, the more people that follow us will actually see it. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, so let's get back to the charts, and you can see back to a really good bullish candle. So now we're only one day into this week, but that's a pretty good bullish candle so far today for this weekly candle, the Hakinyashi candle. Keep in mind, the PPO is already up at 8%, so that's a very high PPO when you're looking at it on a relative basis to say like the past 20 years. Let's go out the past 20 years. We are in the 98th percentile. So, and that measures the gap between the 50, the 10 and the 40 week exponential moving averages, or the 50 and 200 day. So we're not going to start a new 13 week run from here, right? That's not how it works. But it doesn't mean that we can't get another couple of weeks of bullishness with this candle before we potentially get another transition candle. If you take a look at, here, let's just stay here and go to the NASDAQ 100. See, the NASDAQ 100's PPO has pulled back. It's still relatively high, almost the 90th percentile, even with that pullback there. And you can see this week's candle is actually a really small transition candle from what was a bearish move. So you can kind of see the difference between the NASDAQ and then say finally the Russell 2000, which is at its highest level. You know, the 100th percentile, the 99th percentile was just right a couple weeks ago. So again, we're definitely not going to get a new 13-week run out of this. But can we get another week or two of smaller moves because of how high the PPO already is? That will limit the upside. Definitely can do that over the next week or two. So that's how that is setting up. You can see from a 3 green arrow standpoint, we have 3 green arrows on the S&P. The 8 and 17 day moving averages have both crossed above the 30. In fact, we're pretty far up above the 8 day moving average. IWM and diamonds are really far up above their 8 day moving average. If I were to show you this will kind of give you an idea of just how bullish we are in the short term here. So let me get rid of the MACD and the stochastics for a second. And then we'll take a look at how far the current price is. Let's say above the 17. That's kind of in the middle. 17 day, that's the red line right there. You know, how far up above the 17 day are we right now? Well, in the last 6 months, it's the 85th percentile. Only that move off of the intermediate low point was higher. In the last 10 years, we're in the 83rd percentile. So you can see again, there's not very many if I put my horizontal, in fact, if I draw a horizontal line here, and put it at 3.41, which is the current level. Here, let's just make the width a little bit smaller. If you take a look, there's not very many times we've been more bullish over the last 10 years than where we are now. One of those is coming off of a pretty extreme low point there on the credit downgrade in 2010, and then another was back coming off of this. I mean, that's the only other times, and then coming off of this initial surge on the election. Was the only other time we've been this bullish. And all of those we came off of lows. We're not coming off of a significant low right now. In fact, that's probably one of the smaller low points that we've had. When you account for this June peak to be kind of a continuation of that low. And again, you can see how low we got there before the election. So, this is a pretty significant peak, whereas in the past, it's about, on any other normal level, that's about as bullish as we get in this short term. And of course, if I were to put that out to, say, the 30-day simple moving average, right, then again, you can see 82nd percentile and kind of get an idea of just how bullish that is with my cursor as you go all the way over to the left. This is pretty strong bullishness, not just in the long term, but also in the short term. So again, it doesn't mean we have to go down. It just means that any upside moves, as I've talked to you before, will just be smaller. Smaller because of how bullish we already are, and because we're so far up above the moving averages already. If you take a look at some of these other oscillators for the S&P 500, you can see we're still got a very, very low ADX, and the negative line's below 25, but the positive line's not above it. So it kind of gives you an idea of how bullish we aren't And of course the NASDAQ, very, very low positive directional index and still very high negative. So, this is telling us we don't really have a good bullish move going. You look at the RSI for the SPX, we're barely above 60, but we are, and we're above 100 as well, so we're in bullish territory there. But the NASDAQ 100, not the case. Right smack dab in the middle of neutral zone. The Russell 2000, well in the bullish area too. And then finally, let's look at the trend strength indicator with the Ichimoku cloud. No trend going right now in the S&P. The Qs have a bearish move, even though that bearish trend is getting weaker as we're kind of stuck in the cloud there. And then finally, IWM, you can see very, very weak bullish trend as we're coming off of what was a very long, pronounced, very strong bullish trend. All right, now let's take a look at the intraday moves today and look at that closing right up at the 4-week high point. So we are already done this, but you can see the bullish move we made on the Arun indicator, the bullish crossover, very positive development. Even if we didn't have very much of an intermediate decline, we didn't get that positive all the way down towards here. We got in the reversal zone, the positive line, which is the high tag, the 4-week high tag, but still, didn't have any kind of length of time there. So again, very similar to back over here. Now the negative did get up higher, and the positive did get down lower, but that wasn't the case here. We only had the negative got up higher, the positive did not get down lower. Over here, the positive did get low, but the negative never got high. So you can tell the difference between these two versus a real intermediate pullback where the negative got high and the positive, and then we stayed high long enough for the positive to get all the way down here too. A couple of times during that intermediate pullback. If I were to go back a couple of years, again, you can take a look over here and you can see, okay, the negative got higher, and then we stayed bearish long enough for the negative to get down, for the positive line to get down there too. And then back over here on this one, negative got high, and we stayed bearish enough for the positive to get down to the low levels as well. So, you can kind of see what an intermediate pullback looks like, and over here is another one, and versus ones that aren't, where you might get the negative up, but the positive never gets down. The negative up, the positive gets down, but the negative doesn't get up. And then over here, the positive doesn't quite get all the way down. The negative doesn't quite get up above the green line. So, those are all kind of false positives from an intermediate line standpoint. Of course, QQQ, the positive did get up to 0, and we have been bearish long enough for the negative. The negative got up to all the way up to the high level. We've been bearish enough for the positive to get all the way down to 0, and we will stay down there again. It will be at 0 here for a while because we're not going to get, that high point is going to stay over here for a while. So you can see that we are in the intermediate pullback there, and then you look at like IWM, and we never did get. We got the positive up. We got the negative up, we got the positive down, but that was like it, right? That was about as much as we get, but that just goes to show just how bullish the Russell was, because during that seemingly bearish intermediate pullback, we never did break the 23% retracement level on a closing basis, and we've bounced right back up to new highs, and potentially setting ourselves up here for a bearish divergence, right, where we get a higher high on the index, but obviously much lower highs on these oscillators, whether it's those two in particular or the MACD and the stochastic indicators. The MACD would be much lower, and the stochastics also would be, you would consider, especially the orange line, the smooth line version of this. So just something to kind of keep an eye out. And again, it takes a while for divergences to play out, so I'm not looking for like the stocks to falter here and lose this bullishness that it's had over this past week. For the Russell, it's been 6 days in a row. It's not going to fall off a cliff anytime soon. But again, just be wary of how much upside potential there is, since we never did exhale, right? We never did release the bullish sentiment to be able to gain new bullish sentiment again. Let's take a look at the volatility index here, and you'll notice again just how low we are. So again, the second time that we've closed below 20 on the VIX. The second time. The first time was over here, and we were well below the 80% mark over there. and this is the second time, and we're pretty much on the 80% mark. So extremely low volatility. We continue to have extremely low volatility. You can see the big, the faults or the jumps we have, and how immediately we get down back towards extremely low levels. So again, the question is like, how long will that last, and will that, will we get, will this kind of low, will we continue with a relatively low range on a monthly basis, especially compared to the prior months where we had a 16.5 point range, a 14.25 point range, and now down to a 12-point range. These are high ranges, but not on a relative basis. Again, this would be one of the lowest monthly closes that we've had since last November, right? Last November, and the last time we've closed below 90% was over here this past November. And you can see what happened in December and January from a volatility standpoint, coming off of that low point there. All right, so just to wrap up our technical outlook, obviously we continue to be pretty bullish here. I don't believe, based on our routine, that we have actually ended what has been a pretty strong bullish trend since last, November, early November, when we started this current move that we've been on. So we've been on a pretty good bullish run ever since, with a few little hiccups, but not an exhale, unless we're talking about the NASDAQ 100, which hasn't started a new intermediate run yet. So, again, this tale of two markets continues to show up with some significant underperformance in these tech stock names, which happens to be the largest sector weightings in the S&P 500 right now. And these big sector weighting disparities, like what we saw in the tech bubble, like we saw with financials going into the real estate bubble, like we saw with commodities going into the summer of 2008, all these big disparities in these sectors, they tend to work themselves back to parity, so to speak, not during bullish markets. So that's something to keep an eye on. Like if right now we're expecting the NASDAQ to kind of come back from these huge disparities like it did during the tech bubble when that burst, similar levels of disparity actually between the two time frames. We shouldn't expect that will happen while everything else stays bullish, right? Typically that happens when everything kind of runs out of gas and steam. Now, it doesn't happen overnight. It took about 18 months to 2 years for it to work itself out from the fall of 98 all the way through the spring of 2000. And I think we're kind of in the, if we're looking at a similar mode right now, we're probably in that end of 98 time frame right now, as we're heading into the end, what could be an end of this current market sentiment run that we've had coming off of last March's low point. So what do you think? Do you agree with that? Do you disagree? Let me know. Let me know in the comment section below, especially if you disagree. Comment down below why. What charts or indicators are you looking at? Of course, everybody's got an opinion, but share what drives your opinion so that other people can be able to kind of see that too, and see a different side of the market. So share that chart or indicator that you're looking at that tells you, it shows why you might be a lot more bullish than I am or a lot more bearish than I am. All right, I started off taking a look at how, let's continue, with taking a look at what drove the stocks today. Look at real estate really jumping up high today. Gold also up. So you had, kind of physical assets doing very well. Bonds were up too. In fact, it wasn't until the very end of the day that the S&P outpaced TLT, the long-term bond prices. On the other hand, commodities were down. Small caps were down until the end of the day. They rallied to a small gain, and the dollar was up pretty much the entire day. So outside of this move by the Qs, which kind of broke through these safe haven asset classes here at the end of the day, it was a really significant risk off day. Let's take a look at what some of these look like here. So give me 1 second to pull this chart up here, and we'll take a look at some of these. Let's start off with the dollar and see what that's doing, because that's a big driver of risk appetite. And you can see the move back to the downside we're getting in the dollar, coming off of that 23% level, the orange line. I told you in a prior video last week that as we were coming up here, that we probably would end that rally at this old low point, which happened to be at that 23% retracement, and of the longer term move, right, of this long term rally, that 23% line that we have broken right now, and we bounce back up to it, as well as that low point there, the 50% retracement of the current intermediate rally. So the dollar's rally is not done, and it's just a pullback too. It's not a new trend for the dollar. It's just a little bit of a pullback as we head down to where I believe eventually we'll get down to the 1750 area at that point. And whether we get to or not, remains to be seen. But that's kind of where I'm looking at to see long-term bonds. Again, after a significant drop on Friday, not surprising that it's going to make an attempt to go back up. And if you take a look at the Bollinger Band width, especially, if you go back, you have this volume. If you take that volume off and just say, the last little bit here, this last 9 months worth of volume, you can see there's some volume in the TLT right there. And we are down below that, well below the value area, well below that 38% retracement level. I think that's kind of where our next pop in bonds will get to. And today, that puts into context today's move. It's, this wasn't today's rally in bonds was not necessarily a function of, oh no, we need to get safety mode. It's more of a function of TLT is about as low below its moving average here, its 30-day moving average, as it's ever been, right? When you go on a 30-day simple basis here, and you try to see how low we are, we're in that 14th percentile in the last year because of COVID. If I were to go all the way out, then you can see it's been very, very few times that we've been this low. And you can see another example over here in October of 2016, and that started a pretty decent run, and that's where we're at right now. And especially when you compare it to, like, say, a 200-day moving average, for how far below the 200-day, we are extremely low. We're like in the first percentile of the last 20 years. This is an extreme move, and again, we saw something similar, but even this is lower than that. So we are extremes. We are at a support. There's a big gap from Friday. I fully expect that we'll most likely fill that gap in with an oversold technical bounce. Nothing more than that, right? Not a move to risk aversion, just more so a oversold technical bounce. As you can see, again, just how deep the PPO is here between the 50 and the 200-day moving averages, right? They're extreme, the lowest it's ever been. And if I go out in the last 5 years, if I go out in the 20 years, again, very, very significantly low. So we've seen low levels before like this, and it's taken time for them to work out, but you can see how, and I expect that we'll get this kind of move coming off of this low point where we don't go up to a new high, we just go up to a Fibonacci retracement level and then continue the bearish move on bonds, most likely on down into this area, if not down all the way to 100% or lower. All right, and then you look at commodities, which on the other hand has been very, very bullish, right? Not as bullish as we saw in 2008, but absent that move, which was extreme, absent that move, it's about as bullish as any other time we've seen. In fact, we're about as bullish now as we saw in 2011 on commodities, and that was it for the bullish commodity run. I don't think that will be the case either, because we're so much more, we're coming off in such an extreme low point that we're more than likely just going to make a run back down towards, like, say, the 200-day moving average and then pop back up. But this kind of shows just how strongly bullish we are on a lot of these asset classes. It's not just U.S. stocks, but risk appetite in general is so overextended. In fact, U.S. stocks are probably the least, especially the NASDAQ 100, but the least overextended. The Russell obviously is by far the most overextended on this level, at 17.48. In fact, when you look at it on this chart here, this one here, then you can see how far away all these indexes are from the 200-day moving average. The IWM is 34% away. That's more than 3 times the NASDAQ, how far the NASDAQ is away, and more than double how far away the S&P and the Dow are off of their 200. So you can kind of see it's, again, not just stocks, and especially not these stocks. It's more small cap stocks and energy and some of these other sectors that are so overextended from a risk appetite standpoint that's where the exhale is going to be. And that's why I say whenever the exhale comes, you'll see a chart like this here rally up to the upside, right? This will, because it's been so bearish here, and when you look at it on a much longer term level, about 20 years on a weekly basis, and then so let's switch this here to a weekly 1040. Then you can see again, we're coming down to a kind of a Fibonacci support of this rally that we've had off of that November 2016 low. MACD, stochastics, RSI, all extremely low. As we saw, even back there, we were pretty extremely low on a lot of these indicators, at least on the CCI and the RSI. But you can see the CCI is setting up a pretty tremendous divergence right now to the upside. So, once this turns back up, unlike this period, it will start off, at least getting back to the moving averages here, will start off with more of a risk-off move in the broader market in these overextended risk asset classes I've just pointed out to you. So just to reiterate, that doesn't mean I think that the stocks are going to go down. It just means that if we are bullish now, and if you're a premium subscriber, you've seen some bullish trades I've done here recently, as of today even. It doesn't necessarily mean you can't do bullish trades. It just means, to manage your risk. Know what you got. Know what kind of market you got. Don't be a chaser, trying to chase at the very tail end of a move, and just make sure that you're well protected and not overextended yourselves in one direction or another in terms of where you're trading, your active trading especially is. Because an intermediate pullback doesn't impact your long-term trading at all, right? It's your more of your active trading that it would be where you can really get burned if you are overextended in the wrong direction in your trades once there is either an exhale or a new inhale starting. Let's take a look now at the sector performance and see how they're doing here, and just go to just today. So we'll go to March 15th. And you can see, again, real estate and utilities were the best performers. So kind of, again, the same theme of this risk, the safety asset classes and sectors were your best performers for most of the day until discretionary caught up late and technology caught up. But energy, materials, financials, all lagging behind. Industrials were lagging behind until they made a late run at the end. But these were the best performers, and you can see where some softness was today. And where the money was going to, at least initially, in the middle of the day here, when stocks were kind of flat, and it was utilities and real estate that were up more than 1%. And again, you look at their charts, and they've been the ones that have been the most bearish. They're just now turning bullish, right? They're just now hitting 3-month highs in real estate, getting closer on utilities, and getting a dark green shading and a green line. Staples as well, dark green shading and a green line, because we haven't had that in those sectors, especially staples, for a very, very long time, whereas industrials, well off the 30-day moving average, materials, well off the 30-day moving average, energy, well off. So that's going to limit their upside potential because they've already experienced that, whereas some of these are just barely starting. So again, I've shown you this chart before, but it's reflective of this rotation that's continuing in these major U.S. Sectors, whereas all these small sector weighted areas, financials, energy, materials, industrials, are all falling in momentum, even if they haven't started to lose relative strength yet. Utilities, staples, real estate, all rising in momentum and starting to rise and towards that 100 level and gain relative strength as well. So, again, that's what utilities looks like here on a new weekly chart, right? It's turning up. This relative strength line is turning up, whereas say industrials, its relative strength, let's put it against SPX instead of, I think I need to do $SPX, don't I? There we go. So industrials, you can see, just kind of barely starting after losing its relative strength. You look at energy on a weekly chart and how high its relative strength already is, and then materials, how high its relative strength, and it's actually been losing relative strength gradually. It's still at 100, but gradually losing that relative strength. And then financials as kind of peaking in terms of its relative strength. On the other hand, technology has lost almost all of its relative strength down to the downside, and discretionary as well. Once they start to gain some momentum, right? So you can see technology and then communication services, all starting to gain some momentum. Then you'll see that shift into these areas, and again would be more likely coinciding with a pullback in broader risk appetite. All right, so our trade idea of the day is on McDonald's. So let's take a look at McDonald's and see what that stock is doing today. You can see after being in a sideways action for multiple months, kind of a little bit of a breakout today. Dark green shading and a green line. Let's take a look at some of these other charts and see what they look like. You know, above 60 on the RSI, above 200 on the CCI. You can see the breakout up to above 220 there. Look at its directional movement index right here. Look at its directional movement index. You can see we're almost above 30, well below 20 on the negative index. So the ADX is going to really start moving up pretty strongly here again after months and months of just no trend at all. A very noisy pattern that's been gradually getting kind of more noisy, right? Like we're starting to get some pretty significant moves, but most of these moves have been to the downside. This is the first one where we've gone through the cloud, and the red line has also gone through the cloud from 26 days ago. So a very good bullish pattern here, kind of a breakout type pattern that we're seeing on McDonald's. All these bearish and transition candles turning so far, one day in, but so far turning into a very strong bullish candle there. And it's MACD, or it's 8 and 17 day moving average is crossing above the 30, and you can see how bullish that MACD histogram has gotten, more bullish than we've seen in a while. And the RSI is rising up, or the stochastic is rising to strong levels. So what we can do here is we say, okay, unfortunately we don't have the greatest setup because we don't have a 215 strike where I can do a mid 30s and do a bull put spread, which is what I'd prefer to do. So right now what we have as an option is to sell the 230, buy the 220 long call vertical spread, and this sets us up for a kind of a high probability trade. So if we go for like 2 contracts, we're getting about a 2-to-1 risk reward depending upon where you get filled in. We didn't get filled in during our Market Outlook Live because you saw McDonald's was moving up to its high of the day. So we kind of have to keep an eye and try to get at least 2-to-1 on this, knowing that we can get out early, right? We can get out at 50% of this loss, and that would actually turn it into a 4-to-1 risk reward ratio, and that's a relatively high probability trade considering the breakout that we're getting. The options market is suggesting that there's a pretty decent opportunity that McDonald's, who's breaking through its point of control, might continue to break out into this area of very little volume all the way up to that 234 level by April expiration date, which would be past the 230 short strike price, which is where we're shooting for to get our maximum gain. So if you take a look, if we're saying, okay, if we get into this at about the 340 mark, then that sets us up for, actually about 320, I think. 640 for 1360, that sets us up for about, you can even go up to 325. That sets us up for a 2-to-1 reward to risk ratio, which is about kind of what you need to get to make sure we get filled into this trade. We'll put that in our Market Outlook category, and then keep track of it as we go through in our Market Outlook Lives going forward from here. So that's our trade idea for today. All right, you've heard from me now. Now I want to hear from you. Use that link that takes you up there in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new threads. Remember, all of our paid and our free subscribers get access to that forum. So open up any new threads, reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for coming on our video today, or watching our video today. Remember to subscribe to our YouTube channel, hit that thumbs up icon on the video down below, as well as like us on Facebook and Twitter too. That really helps us out a lot, and we appreciate that. And comment on our video. What stood out to you? What questions do you have? Thanks again for watching. Have a great rest of your Monday night, everybody, and we'll see you all next time.